We get to the end of this fiat money system and the fiat money that's pumped up the stock market and the real estate market and the bonds and all of these other markets, when all of that comes crashing down due to the problems with the dollar and our treasury debt, that's where the money would then roll from those sectors into gold. And when it does, that's when gold starts its bubble phase, essentially. That's the last phase of the bull market that I've been talking about for a few years. So right now, gold's been tracing the value of other goods pretty steady, but it hasn't had a breakout. This is just capturing inflation. The breakout in gold comes when gold is seen as the safe haven, the asset of last resort, true money, not only in the United States, but in the global banking system. Money rolls off of all these other markets and flows into gold. And then you get gold as an actual asset class, as money as an asset class. And so not only is it going to track inflation at that point, it's going to go way past it. And that's where that big breakout in gold and silver we've been talking about is going to happen.
As investors and institutions grapple with the mounting national debt and a weakening U.S. dollar, an increasing number of experts, including Roberts Kientz, assert that the tide is turning in favor of precious metals like gold and silver. According to the Congressional Budget Office, as the fiscal deficit is projected to balloon to $2.6 trillion by 2034 and add nearly $19 trillion to the national debt over the next decade, the integrity of the U.S. dollar is at stake, potentially prompting a mass exodus of capital from conventional markets into the precious metals market. According to Kientz, historical trends indicate that gold often leads in such market transitions. Still, silver is anticipated to follow suit and eventually surpass gold's performance, particularly when confidence in the dollar and other assets plummets. A prime example of this dynamic occurred in 1974 when silver, after a period of lagging behind gold, experienced a staggering rally of 125%, marking the end of the initial phase of the great bull market of the 1970s. Kientz underscores the broader global context, noting that the U.S. dollar has seen its lowest level of global reserves since the abandonment of the gold standard in 1971. This shift away from the gold standard, initiated by President Richard Nixon, has left the dollar reliant solely on the faith and credit of the U.S. government. Furthermore, since 1971, there have been growing calls for the demise of the U.S. dollar as the world's reserve currency. Join us as we explore the insights shared by Robert Kientz. Stay updated by subscribing to our channel and activating notifications. Thank you.
Gold in particular, and silver to a lesser extent, but really gold has served its role of accounting for inflation. So in other words, if you look at what gold will buy you now and what gold will buy you 100 years ago, you get about the same amount of stuff. And if you look at how much gas silver would buy you now versus what it would buy you when it was money in the 60s, it'll get you about the same amount of gas. So if you chart out gold and silver to regular everyday things, it'll basically buy you the same amount of stuff. And along the way, yes, there's been highs and lows, but over time, generally, gold specifically and silver to a lesser extent accounts for inflation. However, what would change this time in the next year to 2 years is as we get to the end of this fiat money system and the fiat money that's pumped up the stock market and the real estate market and the bonds and all of these other markets, when all of that comes crashing down due to the problems with the dollar and our treasury debt, that's where the money would then roll from those sectors into gold. And when it does, that's when gold starts its bubble phase, essentially. That's the last phase of the bull market that I've been talking about for a few years. And that would be like eventually the bubble phase of gold, where there's actually too much value in gold at some point, historically speaking, to the value of other goods. So right now, gold's been tracing the value of other goods pretty steady, but it hasn't had a breakout. This is just capturing inflation. The breakout in gold comes when gold is seen as the safe haven, the asset of last resort, true money, not only in the United States, but in the global banking system. Money rolls off of all these other markets and flows into gold. And then you get gold as an actual asset class, as money as an asset class. And so not only is it going to track inflation at that point, it's going to go way past it. And that's where that big breakout in gold and silver we've been talking about is going to happen. Because remember, the historical pattern typically is gold goes first, silver goes second. And silver will range trade like this, where gold is slowly going up. So silver goes like this, gold goes up. There's a big gap in the gold to silver ratio. Gold's been tracking inflation, silver not as much because it's a commodity. But then when you have a collapse in the rest of the markets, not only does gold track inflation, but all of that extra money that nobody wants in stocks and bonds anymore gets poured into gold, and it goes like this. And then silver catches up, and then silver gets to its true value. That's the pattern. So right now, gold for inflation, silver kind of sitting here, moving up a little, but that gap widens over time. That's why the gold to silver ratio is so high. But when the fiat system collapses and these other markets begin to collapse because of the excess money printing and the unsustainability of our spending, $34 trillion in debt, anyone, and $2.50 of GDP to create, or $2.50 of debt to create $1 GDP, meaning we're only getting 40 cents on the dollar for every dollar we spend back. That system has to collapse in on itself. It can't, it's mathematically impossible for it to go. That's where both gold and silver then do this. And this is what everybody's been talking about since the Great Recession, the point that we're almost at now. And they're disappointed because the last 12 to 13 years, gold and silver haven't had that sort of moonshot. And they're like, when's it going to happen? Well, because it's just been tracking inflation, because people haven't rolled off of stocks and bonds and real estate. We haven't had that treasury debt collapse. We haven't had the dollar being de-dollarized fully. It's going right now. That we've had the lowest level of dollar reserves across the world since 1971, basically in history, since it's been a pure fiat currency. And eventually when people lose faith in that dollar and all the other asset values collapse that are based upon the dollar, the stocks, bonds, real estate, all that kind of stuff, even business valuations of a running business that's based on cash, when all that comes crashing down from Exter's pyramid, from all these derivatives into gold and silver.
The precious metals market has recently witnessed significant bullish activity, with gold leading the charge in what appears to be the next phase of its long-running bull market that commenced in the early 2000s. Silver took slightly longer to catch up, but it eventually surged to over $16.20 per ounce during the week of July 15th, marking a significant milestone in its resurgence. Roberts Kientz sees a renewed interest in precious metals due to the declining value of fiat currencies, making gold an appealing store of value. As central banks increase gold reserves, their role as a hedge against economic uncertainty is further solidified. Gold usually rises first, given its history of being taken out of circulation before silver. As both metals climb, Kientz expects the gold-silver ratio to shrink, with silver potentially outperforming. Currently, the gold-silver ratio stands above 90.50, indicating that silver may be undervalued relative to gold, which could be an attractive opportunity for both long-term and shorter-term investors. Additionally, the anticipated Federal Reserve rate cuts in the latter part of 2024 may further drive silver prices, given the historical inverse relationship between precious metals and interest rates. Let's get back to the interview.
The silver pattern goes back much further. He's only done the last 27 years, but it goes back much further because silver's been more freely traded as a commodity longer than gold. Remember, gold had been fixed price to the dollar because we were in the gold standard. We had taken silver out of the money. We were no longer in a bimetallic standard since 64. So that silver pattern is a little bit longer forming, but they're coming together. The patterns for silver, this symmetrical triangle, and the running wedge for gold seem to be coming together at the same time. So in other words, about the time that everything starts to collapse in this fiat system, gold and silver will then align. The gold-silver ratio will shrink together, and they'll both just go boom like that. Again, not a guarantee. That's what we've been tracking on the chart. The chart is backward looking to what's already happened. If this pattern fulfills, in other words, all the fundamentals stay the same and all the humans behave the same way we would expect them to behave when all this stuff comes crashing down, then the chart should fulfill. And when it does, boom, then you got your next move. Next slide is the macro silver chart, 1932, 2024. As I said, silver is in a much longer timeline because essentially gold was taken out in the executive order of 1933. Silver was eventually taken out of the money in 64, but silver is still freely traded as a commodity. So the silver chart goes much longer. And if you look at the silver chart, you can see here a nice run up in silver, and then it came back down, but we've got this cup and handle over 40 years, a 40-year bullish cup and handle in silver up here in the top right. He's got it marked as cup and handle pattern. Okay. That cup and handle pattern, what it's doing is as this wedge is coming together all the way back from 1932, this cup and handle pattern is sort of the culmination of the pent up massive demand for silver, not only as a monetary asset, but as an industrial asset. And so that seems to indicate that when that triangle completes, the cup and handle will complete at the same time. And then you're going to have that launch forward. And because silver has a longer cup and handle pattern than gold, the launch forward should be as a higher percentage, allowing that gold to silver ratio to shrink to what people want it to be. Okay. That's why people trading silver for gold right now, if you're looking at the chart, that's not really the way to go if you believe that this chart will complete, because a silver will, as a percentage, move more than gold. So you want to be trading gold for silver if that's what you want to do if you're trading the gold silver ratio. I'm not telling you what to do, but that would seem to be that make the most sense there. So this running wedge pattern in silver, essentially dates back to 1932, but the current running wedge dates back all the way back to 1980. Why 1980? Because that's when silver hit its high in 50 bucks. And when did silver hit its high again? It hit its high in 2011 when it touched on 50 bucks, right? And that's not inflation adjusted. So actually, if silver from an inflation perspective had reached its 1980 price, it would have gone over 100 bucks, and like 150, I think is what it was. So, but in any case, that's that wedge pattern since 1980, the last time silver really popped. And that wedge pattern is showing that silver is nearing a breakout. Now, the silver breakout, as you can tell, that wedge pattern is a little bit more open-ended on silver. If you're looking at the top right part of the chart and those two blue lines, it's a little bit more open because I think silver big breakout will come after gold. So we go back to gold. Let me narrate this chart. If you look at that running wedge pattern in gold, up near point E or point 2 on this chart, it's got a little bit of space to where that connects, and then you get the big move. In silver, it's a little bit more wide open. I think because silver takes a little bit more time after gold to do the same thing, and because that silver is we're tracking silver over a longer period of time. And that has to do with when silver was allowed to be money and silver is taken out of money versus gold. So gold has a shorter pattern, silver a bigger one. So silver is going to take longer to come to fruition. So gold's going to go first and silver will come after, if that makes any sense.
Gold has shown resilience above $2,030, supported by falling Treasury yields. Silver faced supply pressure after briefly touching $22.80, retreating from multi-day highs. Despite the recent pullback in silver prices after reaching multi-day peaks, what factors do you believe will drive the future performance of silver in the coming weeks and months? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.